our third or fourth dollar cost average position. I always get excited about this because usually on the third or fourth cost average position, and let me just cover that one time again for those that have not tuned into this before or have seen the past reports. You take as a commodity trading advisor and a cash broker in commodities for over 40 years. I'm just telling you what I did as a commodity trading advisor. Now, a commodity trading advisor has discretionary over all of his accounts. In other words, he has permission to trade at will. All right. He provides a track record, and people will want to be with this commodity trading advisor because of his track record. And if you look at my track record on the last 50 since I started doing the market update with Russell Calkins, every single one of them has made money. Now, being a position trader as I am and not a day trader, position traders usually will keep a position for a week and in some cases more than 3 weeks. As long as it goes our way, that's what we want to happen. In fact, we go for larger profits than most all other type traders. For instance, a day trader and that sort of thing, shorter term traders. There's even longer position traders that'll trade off the weekly chart or the monthly chart. All right. Me, I use the daily chart. I will look at the weekly chart, I'll look at the monthly chart, but basically we're working all these recommendations off the daily chart. So generally I stay in a position between 1 week and 3 weeks, okay? So right around 2 to 3 weeks. Lately, though, our profits have been coming in a larger form much faster than that because the markets seem to be very volatile with all the fundamentals. The fundamental is the news events that are going on throughout the world pertaining to your particular market. In my view, a fundamental is already discounted into the market in most cases, or it's discounted into the market and it's still got a ways to go either up or down. For instance, when Russia invaded Afghanistan in 1979, that was very serious because it took 2 weeks to get the United States ships to the Persian Gulf. We sent 280 ships to the Persian Gulf. Russia sent 320 of their ships to the Persian Gulf. It took 2 weeks to meet. Crosshairs were on each other. Nobody fired a shot. 3 weeks later, a wealthy prince sold 400 tons of gold on the open market, and that's what caused the silver crash the third week of January of 1980. All right. So anyway, I'm very excited because we're able to put on our third position. So we started selling on the daily chart using the Bollinger Band. We use candlestick charting, and I'm using the relative strength index today. The dollar index closed at 96.19, and the relative strength index is roughly at 70. At 70 or higher, especially on the relative strength index, it's extremely overbought. All right. And on the other side of the fence at 30 or below, it's extremely oversold. In this case, it's extremely overbought. As a matter of fact, it broke out of the Bollinger Band. 95.70 was the top of the line on the Bollinger Band. The Bollinger Band is basically mathematical formulas, kind of like moving averages. All right. You've got the top moving average, which you may call that a resistance line. And then you've got the bottom moving average, which you may want to call a support line. And then you've got the middle line, which if you want to just go for the middle line on these trades, that's fine. To be on the safe side. If you want to go for a longer trade, you can go all the way to the bottom. I really don't tell people when I get out. I just give you recommendations for when to get in. The reason for that is it's up to you to decide how much money you want to make. You may have goals set in mind for that. And it's very critical, especially in the futures markets, you decide how much money you're willing to lose. That's why when you dollar cost average a position, you take the amount of money that you can afford or willing to lose, all right? You divide it up into 4 parts. Now, this may not be all the money that you have in the markets. This just may be a portion of that money that you are willing to allocate to a new position. You see all the variables that are involved. So in this case, let's say you've got X amount of dollars, you take 10% of the X amount of dollars that are allocated for futures markets trading or futures options trading, and then you divide that dollar figure by 4, all right? And if you make money on the first trade, you make money on the first trade, you take your profits, it's the end of the story. But if you're blessed enough, and what I mean by that is you think, well, if you dollar cost average your position against you, how is that good for me? Well, it's like a rubber band being stretched. And I've mentioned this several times before. If you stretch a rubber band about 1/4 of its stretch and you let go, it may go a nice little distance. But if you stretch it 50% of its max stretch and you let go, it goes much further. On the third dollar cost average, you're stretching it 75% of its maximum stretch. And if you're blessed enough to get 100%, in my view, you've got that thing so far stretched out that when you let go of it, it goes a lot further and a lot faster than the previous position, if that makes sense to you. All right, so we're going to be a seller on the dollar index at 96.19. And yesterday I advised to get into the dollar index on our second position at 95.47. And our first dollar position was at 95. So if you add up 95, 95.47, and 96.20 and divide it by 3, you'll have a dollar cost average figure of 95.55. And the dollar index is currently at 96.19. In my view, that's a beautiful position to have, because only halfway down the Bollinger Band to the middle part of the band, you are in the money significantly. You are in the money by 75 points. It's 0.75 really, because it's 95.55 will be our dollar cost average price. And you want to be a buyer on the dollar index at 93.73. The middle range is 94.72. Now, this is the only position I have right now. And of course, past performance never, ever indicates future profits. Thank you for tuning into the Market Update with Russell Calkins. And be sure to tune in tomorrow. I may do a commentary over the weekend. If you want to watch me live, tune in between, let's say, 5 and 5:30, in some cases 4:45. And may God bless you.